Hi, I'm Pattu from FreeFinCal, and in this video, let's talk about real estate investment trust and infrastructure investment trust. One of the first real estate investment trust, the IPO, has just come out, and there is renewed interest in this. I've already written several articles about this in the past when they were first announced. So, a real estate investment trust is essentially a mutual fund that invests in real estate. An infrastructure investment trust is a mutual fund that invests in infrastructure. We will not talk about infrastructure investment trusts in this video, but I have a FAQ in the article linked below. So the entry amount, the minimum investment amount for a real estate investment trust is about 2 lakhs, and for an infrastructure investment trust it is about 10 lakhs for the retail for the retail public. So that's a little high ticket affair. So we'll not talk about infrastructure trusts in this video. So a REIT essentially operates like a mutual fund. Of course, it is not exactly like a mutual fund. It is more like an exchange traded fund where you have to buy. You can either buy the initial public offer, or you can buy it, then it will list in the stock market, and then you'll have to buy it using a demat account, and then you'll have to sell it using a demat account. So in that sense, it's more like a exchange traded fund. But the structure is essentially the same. You have the AMC, and then you have a fund manager, and then the unit holders are the people who invest, and then there is a trustee who will oversee the operations of the fund, and then there are the assets which are managed by the fund manager. There's one difference between a mutual fund and a REIT is that there will be another company which will actually manage the actual real estate property, and the fund manager will be liaising with them. So in that sense, there's a small difference, but other than that, it's more or less just the same. So a REIT will invest in commercial real estate, so it will buy office spaces typically, and then it will try to get rental income from them. It may try to sell those office spaces if there is a chance. It can also invest in under construction spaces. Typically, much of its investment will be in commercial real estate. So 80% of it will be in the rent generating properties. Rest of it can be in bonds and different kinds of bonds typically. So as I said, it's 2 lakhs for the minimum investment, and for the Embassy Office Parks IPO offer that has just come out, you'll have to buy minimum of 800 units, and each unit is 300 rupees, so that's about 2.4 lakhs. There is no growth option in the REIT. You will only get dividends. So twice a year the REIT will distribute 90% of the income as a dividend, and there can be growth in the value of the units if there is if the assets are sold. Suppose they buy a under construction property and sell it off after construction, or they sell off an existing construction, then there will be a increase in there's a capital gain and there will be some growth. The dividends themselves are tax free. There was a dividend tax associated, but that was scrapped. If you hold the units for less than 3 years, then you have to pay and if you have a capital gain, you have to pay a tax of 15% plus cess, and above that it is taxed at 10% plus cess. It was earlier, the long-term capital gains were earlier free, but now it's now taxable at 10% plus cess. The risks are the problem. So that's the key problem. Now the problem is the REIT is like it is like a sectoral mutual fund, and it has got credit risks like a debt mutual fund. So it combines both properties of a equity mutual fund in terms it invests in only one sector, the real estate, and it has got risks which are similar to that of a credit risk. That is, everything will look okay, then suddenly if there's a default, the NAV will plunge down. So that's the problem. Then there can be delays in construction. There can be legal issues in ownership. Then if there are recessions, then people will not take up the office space. There will be, the company can downsize, or they can shut down branches. Then all that will affect the rental income. We do not have a benchmark to compare anything with. We do not exactly know how a real estate will fluctuate on a daily basis. The NAV will fluctuate. because so far, as we all know, the real estate in India has been has not been transparent at all. It's completely under the hood, and because of that, there can be unknown issues which we do not know. The rental yields in India are low compared to the cost of the property, although it is high compared to the rest of the world, as we will see in the income that you can get is. I mean, not the rental yield, but the income that you can get from real estate is generally high. But the rental yield per se are low, and so you cannot expect an inflation beating return from these. And also, the embassy office parks scheme documents say there could be conflict of interest between different players in the AMC and in the AMC structure, and they could be holding, the trustees could have stakes in the property and so on. So it's a messy affair. So just for that, just because the risks are unknown, you should avoid it. I mean, that should be your motive, and that's just definitely my stance. I don't look at returns. If the risks are not known, stay away. So this is a screen grab from the scheme document. It says that the yields, the real estate yields in India is a bit higher than the operating income yields in India is significantly higher than the rest of the world. While that is attractive, but it's attractive for other people, for foreigners to invest in India. It is not attractive for Indians to invest, because you are taking on so much risk to get this yield. We have nice fixed income assets with sovereign guarantee giving you 7.5, 8.5%. Within that range, 7 to 8%, you have sovereign guaranteed fixed income assets. So what is the need to invest in this? So there are many mutual funds which invest in these REITs. So is it okay to continue? Yes, it's only 10%. Don't worry too much. Think of it as a little bit of diversification. Don't worry. It won't affect you anyway. So in summary, I will say, please avoid these real estate investment trusts because they are unknown instruments. Let us wait and watch. Let us see the risks. Let them evolve. What is the hurry? If they are so attractive, you can always buy it on the secondary market. So don't jump in on this initial public offer. Stay away and watch on the site. So I'll catch you in another video. Bye bye.